Welcome to the latest Motley Fool Scoreboard. I'm Anand Chokkavelu, and we've got longtime fools Jason Hall and Tyler Crowe giving a 1 to 10 rating to a company right in Jason's and Tyler's wheelhouses. It's oil and natural gas play, EOG Resources, ticker symbol EOG, of course. First, we'll rate the strength of EOG's business, including factors like industry and competition. 10 is invincible, a 1 is hopeless. Tyler's at a 6, Jason, you're at a 7.
Yeah, these E&Ps are largely leveraged bets on oil prices over the long term, oil and gas prices, especially in the near term. They really move up and down with that. But this is one of a handful of E&Ps that's built a really strong balance sheet and kept expenses in its operating structure as variable as possible. And Tyler's going to talk about one other thing that really matters that's made a big difference.
Yeah, it's hard to evaluate exploration production company as a general investor because it's just such a cyclical market. I would score it actually much higher if it was another industry. Management has done a tremendous job of wringing out operating costs, and it has really good capital allocation decisions, and it's been the right response to the prevailing oil price environments that it operates in. However, being exposed to the ups and downs of the oil market means that oil prices will always dominate the investment thesis, and that's just a tough market to time right.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Tyler's at a 9. Jason, you're at an 8.
Yeah, management's actually done the things that prioritize a structurally strong business across that oil price and demand cycle versus trying to chase quarterly numbers and largely, as Tyler's going to describe here, drill baby drill.
I got to go off script. I gave 9 to a company that it's called EOG because it's Enron Oil and Gas. So management of a 9 for Enron Oil and Gas. But, I have this story. I overheard a natural resource executive say one time, anytime you aren't putting a shovel in the ground, your company dies a little bit. The decline curve on everything. This is true in oil and gas, especially shale, where the life of wells is so short relative to other types of oil and gas. So there's an immense temptation to just put a drill bit in the ground at all times. But I really have to give kudos to EOG's management and their board of directors, so especially for putting together, I would say, one of the best compensation structures for management of an oil and gas producer. It heavily weights for returns on capital, drilling efficiency, and safety. I know safety is not one you'd normally think of, but hey, if you have a well blowout and a lot of costs, that's one of those catastrophic loss things you need to mitigate against. I mean, they made an acquisition just recently and it was immediately accretive to earnings and cash flow without issuing equity. I can't think of the last time I've heard of an acquisition actually doing that.
It's impressive. For financials, a 10 is a fortress. A 1 is yikes. Tyler's at an 8. Jason, you're at an 8 as well.
Yeah, the financial profile, a lot of it, frankly, is tied to the way the board has structured management's compensation. The business is built for the downside of the cycle. And as a result, it can muddle along when things aren't great, but it can thrive during that high oil price environment too.
Yeah, 8 as well. There's no such thing as a fortress balance sheet in exploration production. We experienced the past 15 years. We've seen it. It doesn't exist. But this one is about as close as you can get. Net cash position, they underwrite all of their new drilling at about $40 a barrel. So we have strong cash generating, fueling a capital plan that's pretty reasonable and throwing a lot of cash back to shareholders. Tyler,
let's move on to valuation. How well will EOG's stock do over the next 5 years? How safe is it? 10's a sure thing, 1's a lottery ticket.
All right. I went 0 to 5 with a safety score of 3. Look, do you know how rich I would be if I knew where oil prices would be in 5 years? I wouldn't be doing these videos. So my mantra is, if you don't know, underwrite extra conservatively. 11 times current earnings at oil right now at about $65 a barrel isn't a bad price. It's pretty good, but it will look pretty darn expensive if we were to see oil and gas go below 50. I'm not saying that's going to happen, but that's what underwriting means. So if we were to see a big decline in oil prices and a decline in the stock price, I think EOG would definitely be on my shopping list.
Yeah, I don't know how rich you would be, but I know how much you are burned from everything that's happening with the oil industry since, call it, 2014. So that might be coloring your score a little bit. I think the safety score is a little higher. That's why I gave it a 5. I also think the floor is around 5% in returns, and it could be higher than that. The price, I think, is generally relatively reasonable to valuations. A single-digit cash flow multiple And a big part of that, though, is the way the business has been built and the way management's incentives help protect shareholders from stupid decisions that have been based largely on bad executive comp plans at other companies over the past 15 years.
Jason, you're right. I wouldn't be very rich, but I would be more insufferable.
Yeah, no doubt about that. Even though it's pretty much already off the measurable scale.
All right, Tyler, let's move on to everyone's favorite topic. Is there a company in EOG space that you like better?
Yeah, I'm more partial to refiners than oil and gas production companies. They're not a growth engine, but they're a returns monster. A lot of like these refiners, they've built out the capital. It's all maintenance capital now, not a lot of growth. I think Marathon Petroleum is the best in the biz. Don't believe Jason when he pitches Phillips 66. Marathon Petroleum's, I think, is much, much better. But I also manage accounts that own HF Sinclair. So I kind of spread my bets around oil refining quite a bit.
Yeah, I think oil refining is fine, but I do like Phillips 66 in this environment. If you want to own a refiner, follow Tyler's suggestions. If you want a great integrated oil and gas company, buy Phillips 66. It has all of the things that you get from the large integrated majors without oil and gas production. It doesn't have an EOG built into it. So I think it's structured well. I think the stock's actually still pretty compelling. They're just coming out of a big fight with an activist investor that Phillips 66 management and board largely won. But the stock still hasn't completely rebounded from that. So I think Phillips 66 looks really compelling right now.
Thanks to both Jason and to Tyler. They've given EOG Resources a meh overall score of 6.2 out of 10, despite strong management and financials. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Carrot Packaging. Till then, Fool on.